seller concession is sacred. Do not give it up, period.
Right.
If you're going to negotiate, this is the sacred number.
We have to look at things and market factors and things that are happening in our market. And we don't really have to forecast a whole lot, but we do have to, make some opinions based on fact.
Everybody should have some kind of hospitality background.
Yeah. In real estate, the hospitality component is huge. That doesn't have anything to do with real estate. It doesn't have anything. That has to do with how well you service those people.
That's right.
What you provide to them and how well you service them. You have to be dynamic and you have to change and you have to look at every opportunity during these downtimes and this uncertainty.
Hey guys, Corey Frills here with the LTW Group, and super excited to have Chris Skalet with us today, who is a local appraiser and kind of a legend. So this is our first Legends in Real Estate podcast. You like being referred to as a legend?
I do. I feel like I'm so old now. I feel it's almost like man, you've really dated me.
It just struck me when the words came out of my mouth how that could land.
Okay. No, it's great.
But man, I just have always appreciated how you invest in our community, and you spend a lot of time with the realtor community and with originators.
Right.
And that's not really a direct crawl for business. If you guys don't know how our business works, we don't get to choose appraisers. It just goes out to a panel and it's randomly selected. We don't know who it is until it comes back. So I appreciate that you do that so freely. And what does make you, why do you invest in that kind of thing? Just out of curiosity.
Selfishly, it's great for business. Honestly, I do it because of that. It's good for business, but also, I say that in a selfish way, but if you're trying to build a business in a community, then you reach out to the people and form partnerships. And I've always looked at it that way. I've always looked at it like with your company, especially. Like with Fairway. I've always looked at it as a partnership between us. And it's never been like I work for you or we work with each other to get things done. So in a community, I think it's important for all of us to work together because I use data from realtors every day to write everything I do. And the better job they do, the better my reports are and the better we have that. But also, I think, when we form these partnerships, it's good for the general public. Yeah. And so your company will be able to explain things to your clients and it'll be able to protect the general public. And I think the realtors, when I market to realtors, it's the same thing. So it's always good for the community if I'm out trying to educate or if I'm going and taking education, like if you teach me something, then I take it back to my office and we make it a little bit better. So the partnership thing is always good for the community.
It's a lot more pleasant. It's a more pleasant way to do business for sure, right? When there's humanity behind it. Because a lot of times, it's like the appraiser. Yeah. But then you get a report and it's got your name on it. Man, it's Chris. Even if it comes in low, it's probably right. Yeah. So it's like, and he'll talk to me, but he's probably not wrong.
No, but there's times though where we may not have some data, and there be times that I feel comfortable enough because we do all these outreach with like your company, and we do presentations and we do all this stuff with other companies. So it's like what. We have this relationship, so I can come to you before anything happens and say, look, if you ever see this, if you ever see it on your end too, you ever see, hey, I've reached out to the realtor and I'm asking them for additional information or whatever else. There's probably a little heads up that I'm struggling a little bit and that you need to really, let's all hands on deck, let's get them as much data because honestly, I've been provided with data after I've reached out and I'm like, oh my gosh. This was a for sale by owner or some kind of crazy. I've been able to use data. I've used we were talking about social media earlier. I've used Facebook and Instagram posts as far as to prove that something was on the market. So and I would have never known that had I not reached out and said, hey, I need some help. Help me help you is what I always look at it that way. That's
awesome. Yeah. So what we're going to do today is we're going to dive into a little bit of just you as an individual and how you got here. Okay. But we have a kind of a wide range of people that consume this content. So I'm giving a quick, entry-level overview of what an appraiser does. Okay. And then you can correct me when I make a mistake.
No, man, let's hear it. I want to hear
let's hear this part. Yeah. So the appraiser's role in our transactions are to establish a fair market value. So some people would say, if you have a buyer and a seller that are willing and they agree on a sales price of a house, then what do we need an appraiser for? If they agree, then that should be the value. But appraisers are actually protecting the lending institution, the bank, the mortgage company, as well as the consumer, although they may not always feel that way, so the buyer. So just because I like a house,
right?
And the example I got the other day was an indoor basketball court. And this house is awesome. It's got an indoor basketball court, so I'm willing to pay.
Right.
I'm willing to write a blank check for it because my kids love basketball, and I love basketball, and we love basketball.
Right.
If I may be willing to pay $100,000 over market value for this house because of the way it is.
Right.
Others may not see it that way. And as a lending institution, if we have to foreclose on a property,
right.
If somebody doesn't pay their mortgage and then we have to turn around and sell it, we have to make sure that we can sell it for enough to recoup our losses on the loan.
Yeah.
And then in the buyer's position, if the buyer purchases a home, they have a job transfer, they have a financial need where they need to sell the home, they need to know that there's other people willing to pay for the house what they're willing to pay for it.
Right.
That they can get out of it too. So that's my brief explanation of an appraiser's role in the transaction.
You're dead on.
Okay.
I mean, that's it.
Yep.
I mean, you're exactly right. I can't add any more to it.
And it's a really important part. It's a really important part of a healthy real estate market, right?
Right.
You have to agree upon value. Period.
Right.
We have to be able to agree upon value.
Yeah, and there has to be, we have to be able to look at stuff. I mean, we have to look at things and market factors and things that are happening in our market. And, we don't really have to forecast a whole lot, but we do have to, make some opinions. Sure. And it's our opinion based on fact.
Sure.
And it's also not very sexy to talk in the terms of like in the lender world, it's like, this is collateral. It's like, no, this is my house.
That's right.
This is my house.
Right.
No, it's collateral.
That's right.
For a loan.
That's right.
And so, and the only other thing I would add to that is that, like, you and I, when you order an appraisal and it comes to our company, you're my client. You have all the risk. You are loaning hundreds of thousands and millions of dollars to someone. So there's a risk factor with that. So they want, you're exactly right. The collateral has to substantiate the risk. Yeah. And then you have unique situations like with the indoor basketball goal. And you know what? That may not be on everybody's list. That may be on everybody's list to write a check. And then I always say this, and you're right on this. If a buyer and a seller agree to terms, that's great. And that very well could be the market value.
Sure.
And I always say this, it can very well be the market value if you just plop down some cash on it. But if you're borrowing money for it,
that's right.
It's a little bit different.
Right.
And so you have to make sure that the collateral's protected.
Yep.
And that actually, I think, it sort of protects the general public as well.
It does.
Because if somebody may not be familiar enough with the market and may not be making an educated decision.
All the time.
That's it.
Yeah, that happens all the time.
Right.
I would also say, to your point about us taking all the risk, a lot of people think because we sell loans that we don't hold any risk. That because a mortgage company originates a loan and then sells it to a servicer.
Right.
We have lifetime. As long as that loan's around,
I know
we're responsible for it. So we have to make sure we make good lending decisions. And even down to the originator level. I mean, they come back and ask me, why we made a call. So.
I mean, Corey, let's hope they don't amortize loans to 60 plus. I mean, it's like, you know what? I'd be long gone. But I mean, it's just like, I get it. And you do have a lot of risk with your collateral. So that makes and that's what you do. But you hit it right on the head. That's what Appraiser does.
Yeah. So where'd you grow up? Let's talk about
right here in Knoxville.
Nice.
Tennessee, go Vols.
Yeah. I wanted to wear orange, but I wasn't sure how it'd go on the camera.
Yeah. Well, you got a little bit on.
I know. That's why I went this way. But it's a football.
I know.
Anyway.
No, I grew up here. I went to Bearden High School, and I went straight through Bearden. You'd have to move about 15 times to do that because they restructure they restructure all the stuff. But I went to Bearden, and then I went to UT, and then I was like, you know what, I got to get out of Knoxville for a little bit. And then every time I drove back in, I'd be like, I want to come back here. I want to come back. So.
That's awesome.
Yeah.
So you got out of Knoxville. What'd you go do?
I used to run around the South and open up new restaurants.
Really?
Yeah, it was for Silver Spoon. So I did that for a long time. Yeah. And so I did that for a while, and I moved I think I moved about 13 or 14 times in about a 3-year period. Yeah. And then, I started, I bought a coffee house in the Old City. This is JFG Coffee House. And then I was playing tennis with a guy. I was just trying to get some exercise because I'd gained so much weight from the coffee house. I was just sitting there eating these ham and cheese croissants and all this stuff all the time. So it was like,
awesome.
So I was trying to get some, and I played tennis with this guy, and he goes, "Hey, my buddy's just started this company, and it's real estate appraisal, and I'd always been interested." So I was like, you know what, I'd like to call him and talk to him about it. Because it's hard to make, unless you're Starbucks, it's hard to make a lot of money selling coffee at $1.35. Well, now it's $2.79 across the hall here.
Right.
But it's kind of hard to make money doing that. So talked to him, and I went to work for.
So were you running the coffee house? Was it your?
Yeah, I owned it. Yeah.
Okay.
So I owned the JFG Coffee House. I bought it from Joe Mason, who's a lady that has developed a couple buildings down on the 100 block of Gay Street.
Okay.
So right around where your office is. So she's developed that big corner building where Nouveau Classics was, and then she did another one, and then I actually lived across the street at 137 and a half. My dad used to own that building.
No kidding.
So I'm a Knoxville guy all the way through. So anyway.
So you owned was the coffee shop in the 100 block?
It was down around the corner. You know where that big sign is on where it says JFG or it says Coffee House? It's across the street from like where they used to have the JFG Coffee.
Okay.
And so it's Robin Easter's design group is down there now. It's down on it's 132 West Jackson.
That's awesome.
Yeah, just so right there. So, but right across the way, they used to like clean. They used to have JFG used to be set up there, and they had these beans that they'd come in, and they would had these big tumblers, and they would clean the beans over there, and then they'd roast them over here on Sutherland Avenue. And we had a licensing agreement to use JFG's name, and then we made all these fresh homemade desserts and all this other stuff. Yeah.
So did you like hospitality, food and beverage?
I've always business. Do I like it? Do I like what I'm doing now a lot better? I'll treasure every Saturday, every Sunday, because when we're running around opening up restaurants and moving all over the place and doing that stuff, it's tough.
Right.
And at the time. And then I think I'll always, my wife always says, that's your love language. It's, acts of service or something like that. Yeah. So I really think that, and also what's funny is my brother and I, we work together now at our company. And he was a bartender over here at Calhoun's on the River. And so we both come from a service background. Okay. And I think it's really helped us a lot as far as building our business and having that type of mentality. So I think it's great.
Yeah.
And that I think everybody should have to do it too. So you know how to act when you go out to eat too.
Yeah, right.
A bunch of jerks that go out to eat, and I watch that. And so anyway, I think everybody should do it a little bit, just to see what it's like to do it, because you walk a mile in someone's shoes and you really find out, how hard it is. But I think it's helped. It's helped me. It certainly helps my brother. I mean, God, those game days when they're doing, selling $300,000 worth of beer, and he's multitasking behind the bar. Dude can multitask like a champion.
That's awesome.
Yeah, so I think it helps, and I think it helps us with our
on beer on game day.
I don't know if that's how much they sell. I'm just throwing out numbers.
That would be insane.
Yeah. None of the numbers that we use in here as far as value or anything else.
I'm going to be on it.
I'd probably say they probably sell about $100,000. I bet you they probably sell $100,000 of beer in a day. Easy.
Now I want to know.
I know.
I want to know.
Okay, well, call Mike Chase. Call Mike Chase.
So have you heard of the book Unreasonable Hospitality?
Yes. Yeah.
I've been reading that one, and he talks about how people from all industries have been going to hospitality conferences for this reason, and I'm reading stuff, and I'm like, this is a no-brainer in our business.
Oh, yeah.
The hospitality, I mean, it will really teach you. And then you think about the experiences you have. Like, our favorite place is Dancing Bear in Townsend.
Okay.
Dancing Bear.
Yeah.
And they always, every time I go, like they've got a system down where they don't know who I am, but they know by the reservation, and they have history and notes.
Oh yeah.
They create the illusion that this is Corey.
Right.
They don't know me, but they've created this experience.
He loves old fashions or something like that.
Right.
It's
They're like, get the
the good bourbon. Get the new bourbon in.
Yeah, so that is a really cool. I'm reading through the same book in our business, so it's pretty cool. I agree. I think everybody should have some kind of hospitality background.
I think so too, and I think there's a lot of things that we can take into other businesses too. And I mean, even if you look at I know maybe some of the people that you work with may actually own Airbnbs or have that. Yeah. That's a real estate component, number one. But there's also, there's real estate component to it, right? Mm-hmm. So there's the property, there's the FF&E, furniture, fixtures, and equipment. But then there's this thing called goodwill.
Yeah.
And so that's like, it's like, why would I drive past like, let's say a Holiday Inn to stay at a Hilton or something like that? Or how is, let's say somebody's a super host.
Yeah.
Well, that's hospitality.
Right.
Period.
Right.
That doesn't have anything to do with real estate. It doesn't have anything. That has to do with how well you service those people.
That's right.
What you provide to them and how well you service them. So even in real estate, the hospitality component is huge. So yeah,
which is why it's hard to comp a short-term rental.
Man, I know I've got it down though now, man.
You got to figure it out.
No. I actually I wrote up a couple of reports, and then I challenged them. I submitted them to 2 guys that are on the state board for the appraisal commission here locally, and I said, chew this up, spit it out, pretend like I could go to jail if I did something wrong. And they worked through it and gave me some suggestions, and I think I have a report that will not only conform to like your stuff, but will also do that. So anyway, that's a side tangent. But yeah, I perfected the specific form for the short-term rental. I've got it down.
Okay, so
because there's a lot of cases right now in the state where people have not been valuing them accurately.
Well, I mean, so okay, I do this. We should take this tangent. This is worth tangenting on.
Man, I will go down every rabbit hole with you so far.
You have put together, scientifically or otherwise, a observable, repeatable, measurable way.
So why do you drive by Hilton to go to a Holiday Inn? Whatever it is, right? That's the best way for me to describe goodwill. Well, there's some transferability to some things, I think, in real estate. But like if you're a superhost, let's say you, Corey, you own like 2 or 3 Airbnbs.
I am actually. I own one, but I am a superhost.
So you own one. Okay, I'm going to use you as an example.
That's correct.
So you own an Airbnb and you're a superhost, so which means that you're good at hospitality and you're good at taking care of people and you're taking care of everyone that rents from you.
Right.
That component doesn't transfer to the next person.
Correct.
Because they could be a real
host
jerk.
Driven.
And they could be and it's host driven, right?
That's right.
So I have to be able to look at the transferability, I think, of that goodwill component.
Yes.
And so I have to be able to explain that to a lender, or I have to be the intended user to see, okay, does that transfer, does it not transfer? And how do I assign value to it if I can? So that's the tricky part of valuation of short-term rentals. Okay. So there's that. And then the other component I think that a lot of people get wrong is, well, there's a couple things I think that I do differently. One is a lot of these short-term rentals are sold furnished. Well, you don't like personal property in your world, right? I mean, don't. I mean, if anybody puts any personal property on the contract, you're like, oh, why'd you do that?
Let's talk about why is because you can take the table out of the house after you buy it.
Right.
It's not collateral. It's not affixed. It's not real property. That's why we don't like to value the furniture in an appraisal.
So we talk about whether or not it's real estate. So it's the method of attachment, I think, is there. And then with a business, you have furniture, fixtures, and equipment. So let's say you're selling like a pizza building a pizza restaurant, right?
Right.
Well, those ovens in there, big pizza ovens and stuff like that, or a big wood-fired something with like that, that's a fixture. That's part of it, okay? Right. So in real estate, like with short-term rentals, you sell those furnished.
Yep.
So I have gone and I have interviewed 15 different well, this is just specifically for like Sevier County.
Yep.
And then I've tried to, and that's, big, all the cabins, but I've interviewed 15 different, so far 15 different owners of short-term rentals there, and I've calculated sort of how much it costs to furnish one of these, including down to the pool table and your chairs outside and dishes and coffee machines and whatever
towels, silverware,
exactly. Everything that you need. So then I've taken that, and a lot of guys have broken it down. They're like, guys that own multiples are like, yeah, it's, on the luxury side, it's $20,000 per bedroom is the way they estimate it. So I've interviewed a lot of different players in that. One is a guy that you guys know and Lisa knows really well is Jason White helped me out with some, because he can run the whole gamut, and he's been selling real estate up there forever.
Yeah.
He was a really great resource. And then, so those guys are great. But so I've done that. Then I went and I worked on it with my interns, like our intern project. I was like, let's do low end furnishings, let's do high end furnishings, let's do that. And then we were on Amazon, buying like dishes and plates,
Sure.
and pot holders, and we did everything. So we've calculated how much it would cost for the furniture, fixtures, and equipment. Well, this is where people get in trouble. Houses sell in a ready-to-rent state.
Yes.
In Sevier County, or even here, you may sell your Airbnb with everything in it, right?
White County, same thing.
Yeah. Okay. So you may sell yours, and you may sell everything that's in it.
Yeah.
Well, when it sells like that, you have to deduct the furniture, fixture, and equipment cost or price or value from the total. So if it sells for, let's say, $500,000, and you've got a $40,000 in FF&E from it, you deduct that from the total because it's sold with it, and you want to know not how much is that.
What's the house worth?
Correct.
Yep.
So we have to take that out. Even though ours may be selling fully furnished, and it's funny because ours may be selling fully furnished, but you don't want any of that furniture or anything in there. Well, these, we know that if we know they sold fully furnished, we have to deduct that from the actual total. So that's one of the components. Calculating the goodwill is the other component, and then the last component really is developing a really great gross rent multiplier. So you take like the rent or the amount of money from the income, and you multiply it times a multiplier.
Okay.
And that helps
selling a
you.
business.
Correct. Right. So it's a multiple of the earnings. So it's basically, and you hear everybody say, talk about, multiples of earnings, but you take that and multiply it times the multiples of the earnings to come up with a value too. And that's a recognized method, but here's where it gets weird. You guys ask me to do a form sometimes, and Fannie Mae's form is all bunch of messed up.
That's right.
Because you're asking me for long-term rentals on a form.
Yep.
For short-term rentals.
Yep.
And so I always say, can I just not have this form in the report, and can I just simply do a narrative for you and provide you with what I do is I come up with sales of short-term rentals that have rental history, and basically, if you have a $1 million property and it makes $100,000 a year, the multiple's 100, right?
Yep.
Or whatever. So 10, not 10. Well, not 10. Is it 10? Yeah, that would be 10. Yeah. So the multiple would be whatever, if that's what it is. So you multiply, the earnings times the multiplier, and that gives you the value. So you either have those things that have sold, or you have one that hasn't sold, but you've got rental data for, and then you have to come up with what's called a proxy sale. And that's, a lot of people are worried about that, but it's like, if I have another cabin that's right next door that's sold next to yours, and I know that one's doing $100,000 a year in income, and this one just sold for $1 million, that could be a great proxy sale. Same number of bedrooms, baths, it's on the same street. Yep. So you could use a proxy sale to develop a multiplier as well, and to get your data. So a lot of people are like, no, it didn't sell, and it wasn't a rental. I was like, no, I mean, these are recognized methods, and it's this whole test of reasonableness. Yeah. You're doing the income approach, you're doing the sales comparison approach, you're doing all these approaches. So that's how we go about doing it.
So you're valuing three components. You're valuing the dirt and the real estate itself. Mm-hmm. You're valuing the business component, which is the revenue, and then you're valuing the FF&E. And so it's like you have real estate minus FF&E plus. Is that right?
Well,
am I seeing that right?
It's real estate minus the FF&E,
right?
And then what's attributable to the goodwill component is part of that.
Okay.
So that's part of developing that.
But goodwill doesn't transfer.
Right.
Is that right?
Well, it could.
Okay.
It could potentially could, and that's it. But my point is, when you buy an Airbnb if I'm buying an Airbnb from Corey, I don't get to be superhost, man. I got to earn that.
You got to start over.
Or if I buy one of these cabins, you would have to literally be able to figure out, the expertise of the management company, right. And so is the management company taking professional photos of your house? Are they advertising it properly? Are they taking care of the guests on check-ins? Are they taking care of any kind of maintenance issues? Are they doing whatever else? that might not be a transferable thing because you may not. You may say, "I'm going to do it myself."
It could be documented in the contract, though, too, right? Hey,
Sure.
just to remain with X management company, and that would be, I would think, for you, easy to say. Yeah, it transfers. It's right in the contract. It has to be with them for however long.
And I may not have to come up with an actual component of evaluation, but I may be able to analyze it and do it in a qualitative way, and just saying, "Look, this management company has, a ton of expertise. They charge this. They've got great ratings. They've done this." And so if I have a range of sales and it's like 900 to $1 million, I'm going to say this is if they're staying with this company, I could attribute them having excellent goodwill. So I could be on the higher end of the range, and I'd say the only reason I'm on the higher end of the range is because I really think that this management company that's transferable, they're solid, they've got great reviews, whatever, and it takes a little bit extra. But as far as evaluation, you're always going to do the cost approach. What would it cost to build? If it's an older house, you don't do that because it's not really applicable. Then you're going to do the sales comparison approach or comps. Just when you're doing comps, got it back. If they sold furnished, you back at F&E. And then you've got your income approach, which is like that multiplier. So developing a multiplier and using different techniques to develop the multiplier.
So I guess that's where I'm at, is I'm seeing, because I'm thinking in my head, oh man, if this is new, we're going to start getting hit because they've always transferred with furniture. But if you're deducting for FF&E, but then adding back something from income, that's probably washes or comes out somewhere.
Yeah, you're right. You're right. And what's funny is people are like, "Hey, you have adjustments for all this sales," and I'm like, "Well, they all sold furnished, so I have to deduct that from the total." And so there's a lot of cases. Well, what's funny is, Corey, there's a bunch of cases out there right now where cases that have been complaints have been filed because people haven't been doing this properly. And so I was like, you know what, this is an opportunity for us to not only, I don't want to be so much an expert on something where I'd like to be sort of more of an authority on something. I think that's more important. So I was like, let's go out, let's do something, let's write this report, let's put it out there and put us. I don't think I have a whole lot of liability when but it's a crazy process to submit it to two guys that are on the state board to have them review it, basically to see if you're doing stuff right or wrong. That's a lot. So we test that.
That's cool.
We test that. It's like an accountant that would maybe test stuff with the IRS. To see if it would stand up to audit. So that's kind of the same thing. And so that's why we would like to be an authority on this kind of thing and be on the forefront of it, because we think, there's not enough classes right now about short-term rentals. Realtors maybe not as educated as they should be on all the data that they need for a short-term rental. And then, you've got Fannie Mae and Freddie Mac and people that buy loans that are saying, hey, please fill out the long-term rental form for a short-term rental. And so it hasn't really evolved and become dynamic enough to do short-term rentals. But we see at our company a lot of opportunities with doing short-term rentals properly.
Well, and you have agents that do short-term rentals, no short-term rentals. If you kind of step out and you dabble here and there, it just gets complicated. There's just a lot more that goes into it. And
there's a lot of components, but I think understanding the components and then how to properly value those components, that's something that I've made a big focus on it when interest rates crept up and I had some time on my hands. I worked on professional development and doing some things to put us into new businesses, and to new niche, I guess, a new niche for our company.
Man. That's great. So, all right, that was a worthwhile tangent.
I think so too. I love short-term rentals, and I think a lot of applicability.
For sure.
And also from your standpoint too, another thing, last thing, there may be short-term rentals out there that aren't legally permissible.
Oh, for sure.
So there's a lot. When I go into AirDNA and I use that to analyze some of these short-term rentals, actually our whole office will use it. But when we do that, it's like, hey, we're going to have to do this as a long-term rental for your company. Like if you do it because this is an illegally zoned. Is a legally zoned Airbnb. So this is, and you can't have that. It's like, is the present use currently legal use? And we say no. Nope. Yeah, you're never going to write a loan on that. Too much risk, right? So
no, that makes perfect sense.
Yeah.
Yeah, I like that. All right, so
okay, we went on that was a rabbit hole.
it was worthwhile.
Yeah, man,
it was
good.
worthwhile,
Okay.
and I learned. So I did not know that
Okay.
it was that. I love it. So I just figured because they all sold furnished, and that was just a comp.
Yeah,
We don't talk about it. It's not in the sales contract. I mean, it is in the MLS description, like
Right.
98% of the time, which I think is not great, you know.
well, that's how. And then we call the agent and interview them. So,
Yeah.
and say, yeah, they're like, yeah, it's all
Oh,
furnished.
yeah, that's great.
Yeah.
Yeah, okay. All right, so coffee house, somebody says, hey, got a real estate company, you should go. When is this?
Yeah,
Give me a time range. if you
God,
don't care.
19 and back in 1997, back in my day.
That's a
No,
great
so.
year. That was a great year. 97?
Yeah, so
Fantastic.
97, but moving in, I got into the business in 98, so it's always really easy
Awesome
to
year, too.
remember.
Yeah.
Yeah, it's always, that was a really great year. So, played tennis with this guy. He said, hey, go talk to my buddy. His name was Doug Blackburn. His dad was Doug's dad was on the appraisal commission, and he and a guy named Sean Smith had started a company, and they were hiring people. And so I was like, hey, man, he's like, yeah, you can come on board. I will train you, do whatever. And then so they trained me up, and then they decided, that they would just sort of grow the business. So we had a Knoxville office, then they opened up Nashville. Well, I mean, I'd moved 13 times in like 3 years. So they're like, hey, you want to go run the Nashville office? And I was like, no, I went.
Oh, you did?
So I went to
Okay.
Nashville, man. So I went there and started working there, eventually got my license. And, that was back like 2000s, early 2000s. So at that time, you were probably 2 years old. So,
I was in high school.
okay, whatever. So anyway, so the big fish was eating the little fish, right? So the big companies, the back of the time, I don't know, all the tech companies, everything that was happening. So the big fish was eating the little fish. So these guys put this company up for sale, and it was sold to a company. And the company's idea was to have like a one-stop shop. So they're going to have like, home inspectors and a title, like relationships with all these people, not loan stuff, but everything that was ancillary to the loan, like everything that we do, home inspectors and appraisers and surveyors and whatever, they were going to do this. So they bought the business. Those guys sold out. And then, I think I moved back to Knoxville, and then all of a sudden I was like, oh, they just laid off the home inspectors, and oh, wait, this is happening. And I thought, you know what? You start seeing writing on the wall for that kind of stuff. So I was like, I'm not going to get caught up in this. So another guy that was there, he broke off, and I went to work with him. And after owning the coffee house, I did not want to own my own business. I just was like, hey, man, I will be your greatest worker ever, but I'm going to go home on the weekends, enjoy my time off at night times and that kind of stuff. So went to work with him and got my license, and I became a certified residential guy. And he had hired some trainees, and I was spending more time with those guys than I was like writing on my own reports. So I was like, hey, man, can I have a little bit of the juice from those guys? I was like, because I was helping them produce reports, whatever. And he's like, no. I was like, well, okay. So then I was like, hey, I'm still helping them. Can I have a little bit of the juice from those guys? And he was like, yeah, no. And so I was like, okay. I've kind of got to a point where, me helping them and them coming to me, I was like, okay, I'm going to have to do it. So I just broke off. I was like, I'll just have a little one-man shop.
Sure.
And so that was about 2000, right around 2001.
Okay.
Maybe 2001, 2000. So that's when I started Advanced Appraisal Services.
Yeah.
And so the rest has been history.
And that was .com. That was
Advanced,
right?
yeah, that was right around then. So, I mean, what's funny is just watching the whole technology evolve and everything else. But we have just now, so that started, we've grown, and we've moved from a house to a house to a house to an office, and then finally our office that we own now. And we've grown to seven certified appraisers there, and support staff and data entry people and an office manager. If you call my office, somebody answers the phone, and so things that we think are really important. So it's grown to there, and then I just signed a joint venture with some guys with a commercial company. Guys that I worked with in Nashville when I first went down there after I played tennis with my buddy. So he actually, it's funny because he's got this really super successful commercial company based out of Nashville. Mm-hmm. And so he's like, hey, let's do something. And I said, okay. So we started flirting in October, signed a joint venture agreement in December. So I've been offering commercial services, real estate appraisal services out of our office. And then I owned KnoxvilleAppraisal.com. Well, they've given me an opportunity to put an office in in Middle Tennessee.
Okay.
They're based out of Lebanon. And so we have this partnership now with these guys. We're doing commercial. They have a commercial seat in our office. And I now will have, we are opening up, we've already done about 60 appraisals out of the Nashville office. But we now have an opportunity. We're going to have our official opening in July 8th. But we had to rebrand the company because Knoxville Appraisal didn't really translate great. It still doesn't even translate really great to Severe. So now we're Advanced Appraisal TN, and we got a new logo and all this other stuff.
Cool, man.
So we've done all this stuff when times were a little bit slow, you know, to transition the business to. And then, you know, I'm excited about our Middle Tennessee market. I like using that MLS there. I can't wait to meet more realtors there. Our office is in Lebanon, which is and it's downtown Lebanon.
Oh, that's cool.
Valley Quarry's cool. It's cool as hell. That place is it's just a small town, cool feel. They've got like these new breweries and restaurants and little eateries.
I went to MTSU. I lived in Murfreesboro for 6 years. I've never been to downtown Lebanon. We get off the Lebanon exit every time we went to Murfreesboro. But I've never been downtown.
It's so well. We have 2 buildings, and then the guys bought another one, and it's like where Sam Houston's original law office used to be.
Oh, that's cool.
But I'm literally, it's not even 2 buildings away from what they call the Square.
That's cool.
But the Square's got like vintage guitar shops and little bakeries.
We don't have those here. Middle Tennessee has all the squares. Like Murfrey has a square. Lebanon has a square. I think those are so cool. Like the courthouse in the center.
It's like this has like some kind of I should know who it is, but there's some kind of, you know, frontiersman in the middle of the square that everybody drives around there. But you walk everywhere, and then, you know, and there's new restaurants popping up across the street, and so I love it because it's urban in a small town feel. So we've got 2 offices that are, you know, commercial. There is their bread and butter, and then they've given us the whole building for our residential department. So we're slowly adding on and growing that too. So we rebranded, and we've done I'm telling you, change your emails.
Oh, dude, I know. I've done it.
It's just tough.
It is a lot.
It's tough, and so it just changing.
Hopefully the old ones communicate with the
they do. They push them through, but I mean, even then, you know, you're nervous, right? Because you're like, what if Fairway can't get in touch with me?
Right, yeah.
What happens if I miss an order? You know, you're a nervous wreck. So anyway, we rebranded. And so things have been, you know, things are kind of, you know, our commercial business. I mean, what's weird is with the commercial thing, we haven't done much lender business because I haven't gone out and like, I haven't even promoted it because these guys here are so slammed with all our, with the other types of businesses as well. So.
That's cool. So you kicked off in the early 2000s. So you rode the 3, 4, 5, 6, 7 wave. And you probably thought like, man, this is the best thing ever. So we're going to stop. And I mean, at what point? I mean, is that how you felt? Or
I did. But the wave was great. But I got to tell you, when the subprime market melted down, when that melted down, you know, interest rates kind of, you know, dropped then too. So even going through that, the refi boom, that's probably the second busiest we've ever been, which is weird because, you know, when the economy's good, we're busy, but when these horrible things happen, the rates drop and we get swamped. So everybody's like, God, this is horrible. This is horrible. I'm like, God, I'm so busy. I don't want to be a jerk and tell you how busy I am, but I don't want any more business right now because it's that busy. So that happened in COVID, and that happened in after the subprime tank.
But there was probably a window, I think it was September of 2008 when it really caught flames, right? Bear Stearns went down. That you were like, oh no.
I know what's going to happen with with this, and then, you know, all these companies were.
COVID was like that too, but it was for like a month. It was like March, right? March of 2020, we were like. And then April, I remember the day, because I watch mortgage-backed securities. And I remember the day that the Fed turned on the faucet and started buying mortgage-backed securities.
Oh, it's like the
fire. And the candlestick was like, whoa! Mortgage-backed securities just dumped 150, 200 basis points in a day, and then it just kept going. And you know, I get super excited about that stuff because it's what I watch every day. And literally nobody else cares that I wasn't actually took a brief hiatus from mortgage at the time. I was working for a local bank in a private wealth office. And so those guys were interested, we were all interested in the market, but like mortgage-backed securities were like, oh, whatever.
Yeah.
But actually, I subscribed back to MBS Highway, which is who we use for mortgage-backed securities tracking, because the commentary was so good on what was going on in the market.
Oh yeah.
But that was absolutely fascinating. But there was a window, and it might have only been even like, it was like a window of a month of fear that you're like real estate transactions.
Right.
We had people bailing out a contract.
Oh yeah.
Like they're just like, nope, I don't know what's going to happen here.
I know there was
and
that
then all
uncertainty.
of a sudden it was like, whew, and never slowed down.
That was nuts. The beginning okay, so that happened, and I remember I was like, you know what? I was like, we're getting all these directives from mortgage companies, from like you guys. It's like, hey, you know what? You really? I was like, am I going to be able to ever go into somebody's house again? I mean,
right.
am I going to be able to do that? I mean, because there's like, hey, or then you call up the house and they're like, hey, we have COVID. And so it's like you can get into the house eventually, but so there was a weird uncertainty. We actually used this we invested really heavily in a new server. My guy Jake Gaston at Computers Etc. He hooked us up. He made us to where we could expand all these terminal and virtual servers, and so that's when I think we made a big jump technologically, and we actually took advantage. I hate saying taking advantage of it, but we were able to, go paperless, go work remote. Work was huge for us, because people didn't want to come into the office. Yeah. So we were able to transition that, which has actually helped pay dividends on down the road, because now I don't have to add office space if I add someone.
Yeah.
So we kind of got the infrastructure in place. But yeah, there for about a month, God, I was like, I've got an emergency fund, but I don't know how long I'm going to be able to live with the way my people spend money.
Dude,
so yeah,
I took a defensive draw off my HELOC. Like I went and grabbed some money off the HELOC, and because I was working at the bank and people were doing that, I'm like, that's a good idea. So I went and took one off my HELOC and threw it in savings.
Yeah, see,
just because you just didn't know.
Yeah, you done uncertainty.
And the banks will shut them down.
Right.
If it gets bad, they'll shut the HELOCs down.
Oh yeah.
So
yeah.
So at what point in 2007 did you start kind of scratching your head and being like, this feels like off? Something's up.
No, I knew that because we'd done work for some of the subprime people, and they were borrowing so much more, and we couldn't appraise those things, And I was like, they're trying to borrow 110 and 115% of the house. And they'd ride their bike down to the bank and be like, hey, I don't have a job. And they're like, oh, well, you can pay 15% over the list. And so we were having a really difficult time appraising. And I was like, where's the gap here? I wish I'd have been smart enough to say, okay, I'm going to invest, and I'm going to be like, the Big Short,
right?
And be like in
short mortgage-backed securities.
To be like, let me write an algorithm and a derivative and do all that stuff. But no, honestly, I was like, we started seeing the writing on the wall then. And then there was the whole home valuation code of conduct and all that kind of things where that came out of this. But I started seeing, okay, well, this isn't going to be good for the appraisers as a whole, because the lender's not going to be able to go directly to the appraiser, because there was a lot of there was coercion at the time, and there was a lot of things that, hey, this guy will make this work or whatever. And so I was like, those things don't go away. Just like you said, man, those things don't go away. They don't go away on our part. And, there was times where we had like crazy, like I remember like Chase filed a complaint against our company. It gave me so much anxiety and all this stuff. And the whole basis of the complaint was the appreciation from the time from a prior sale to the appraised value. Well, if they had read the report that they filed the complaint on, they would have saw that it was a lot purchase for $75,000, and then they built a house on it.
That makes a lot of sense.
Okay,
it's worth more.
Well, I had anxiety like crazy, but everybody was trying to blame, coming back and trying to get everybody to buy everything back. So anyway, we saw the writing on the wall. Then every time there's like a big change, we're trying to stay dynamic and we're trying to stay ahead. So when the HVCC and then the whole appraisal management thing came out, and I was like, oh my God, there's all this uncertainty in the market. Now they're going to start having appraisal management companies, or they're going to have whatever. whatever. I was like, let's get on every bank's list and every lender's list and everybody we can get on right now. Let's market like a mother, and let's get out there and let's get on every list we can right now. Even if it's slow, we're going to do whatever we can to do that. So we use, every time there's something odd like this, Corey, we're always trying to look at it.
Head down, working through it.
Yeah, no, we're always trying to be dynamic. You know, I think it's important to have systems and processes and the ways that you do stuff. But one of my guys will say, well, you told me this is this. And I'm like, God, I was like, we have to be a company that's dynamic, and we have to be somebody that's fluid. I know I told you that, but you know what? You have to say, maybe that's not the right way to do it now, but we've always changed.
Right.
And so I always tell the guys, I'll tell all my guys this. I'm like, look, are you Blockbuster or are you Netflix?
That's right.
Are you going to base your whole business model on late charges and a tape charge? Or are you going to be Netflix and you're going to ship stuff to people's house at the beginning and let them keep it as long as they want, and then evolve into, you know, a media company that's worth billions, you know? So which one, I'm not saying that. I'm not comparing us to that. But I'm just saying,
but it is,
you have to be dynamic and you have to change, and you have to look at every opportunity during these downtimes and these uncertainty.
There are lessons in history. One that I don't hear a lot of conversation about, but one I think about a lot is Sears and Roebuck.
Oh, yeah.
Versus Amazon. I mean, Sears and Roebuck, they had catalogs in the 1800s.
Right.
You could buy a house.
Yeah.
And have it shipped to you.
Yeah, yeah.
In the late,
Yeah.
Early 1900s.
Yeah.
They had a 100-year head start on Amazon.
Right.
How in the world did Amazon with the same model?
Right.
The same model.
Yeah.
And so
why didn't they evolve into something that they could have? And so I look at that too, and now you look at things like Amazon now, and you look at players that have been in the market for a while that know how to, like, for instance, Walmart Plus. Like, now Walmart Plus is taking a big cut into Amazon's business because they're giving better delivery services and quicker services. They already had the infrastructure in place. So they realized that, hey,
what are we thinking?
Yeah, it's like we have this great opportunity to evolve too. I mean, there's enough for everybody, you know?
Yep.
And so I see those companies start to evolve and do that stuff. So, I mean, are they Blockbusters or are they Netflix? And so I still have guys that I call Blockbuster guys at my office who are out there with a piece of paper, and then they're taking the paper and they're putting it into different stuff. So anyway, we are always trying to evolve, but we take advantage of like right now, you know, interest rates were high, things were slow. We always are going to try to take advantage of the situation to expand our business and find new avenues.
Yeah, I love that. So what are you seeing now? What do you think is interesting right now?
Now, God, you don't want to hear this.
I do want to hear it.
No, you don't.
I do.
No, it's, well, I mean, this is sad, but, you know, I mean, there's, you know, you guys are out fighting for deals left and right now. My non-lender business has been a focus of ours, you know, so we've been doing estate work, we've been doing trust work, we've been doing divorce work, we've been doing these big portfolios for like valuing like big portfolios for people. So we've had to evolve to that, you know, just because people haven't come to the conclusion yet that, hey, that was an anomaly. COVID and the rates were an anomaly. So we use this slow time to develop a new website, develop the new brand, do that kind of stuff. So, but what I'm seeing right now in the market, still we still have prices that I think are high, and they, you know, they went up like crazy. I think they've stabilized somewhat, and I still don't see any demand, but I think right now is a good time for us because I've seen a big uptick just recently. I think right now people are starting to get off the sidelines and realize, hey, I mean, I can't stay in my 1,500 square foot house. I need, you know, at least, you know, 2,800 because I've got like 3 kids or, you know, whatever. So people are getting off the sideline and they're realizing, hey, I've got to bite the bullet. I know I'm locked in at I call it golden handcuffs. I'm locked in at a 3% rate, but I'm going to have to bite the bullet and do a 6% rate, or I don't even know what they are right now, but I'm going to have to bite the bullet and do it. And this is a rate historically that is completely great, but nobody can wrap their head around that. And I think that's because the prices have gone up too. So your payments are naturally going to increase, but historically that's what it is. So jump it. So get back in. Because you can't be, I mean, the golden handcuffs are, you know, like all my friends that sell pharmaceuticals, you know, they make all this money, but you know, it's like it's a volatile job or whatever else. But now you're locked in at 2%. You got the golden handcuffs. It's like, why would you ever leave? Right. Well, you need to leave. You can't stay in that house. It's time to move it on up.
That's right. Yeah, I think you have to zoom out. You know, and you're right. There is no. I think people use the interest rate. Oh, these are historically normal rates, and as like a what do y'all? Well, yeah, historically abnormal prices relative to income. I mean, affordability is a huge problem.
Oh yeah, right? yeah.
And so that it just is. It's a huge problem. So we see that, but then our conversation before we turn the cameras on, we're talking about just a huge lack of inventory.
Yeah.
Period.
Yeah.
And so you can have two things can be true at once.
Right.
You can have uncomfortable prices that are pushing market's bearability.
Right.
And you can have a very robust lack of inventory.
Yeah.
That's still pushing prices higher.
Right.
Like, both things can happen. And so I think you have to zoom out a little bit. I think about cities like Boston that and New York, where some people have spent their entire lives spending 30-40% of their income on housing.
Right.
If you want to live in Boston, that's where it goes. If you want to live in New York, that's where it goes.
Right.
So there are lots of pockets of the country, I would say on the West Coast is similar, that people have spent 30-40% of their income on housing, and that's just not something we've had to do here in Tennessee.
No.
And so I think that takes some adjustment. What we're seeing, and I'm sure you're seeing this a lot too, and probably have opinions on it, but the really what's kept us moving is seller concessions.
Okay.
So seller concessions towards an interest rate buy down to make the payment more bearable. And either I personally, I default to a permanent buy down. Don't love temporary buy downs.
Right.
They have a place.
Right.
And I have clients that love them.
Yeah.
But it's a specific need. I like the idea of just forever, you know, and housing is secure. And,
I like to lock it in.
Housing, I don't like to, I'm very risk averse. I don't do ARMs. I do not originate ARMs, period.
Okay.
Fairway does.
Right.
There's LOs on my teams that do, but I don't do ARMs. I don't like them. It's just my personal opinion. Again, if a customer wants one, I'll direct them to somebody who does. But and there's people smarter than me that have opinions that they love them. But I personally am a very risk averse. And so anyway, but that has kept the market moving because you have comps that support values, but then you're also seeing negotiating room and you're seeing price reductions. And so our pitch has been, hey, instead of asking for a lower sales price, ask the seller for the biggest concession you can get. And we can impact the payment by $200, $300 a month versus $60, $70 a month by buying that rate down. So that by buying the rate down on a permanent 30-year fixed, right? So the challenge there, though, as you know, is you can't. The market's not always going to support like, hey, hey Chris, I'll give you $500 for this house, and give me $20,000 a seller concession. The seller's like, no, give me $520 and I'll give you $20. Market may or may not support that.
So, and it's a hard sell for your underwriters too. In that position right there, it's a hard sell. No, I'm totally with you, and I'm with you there too. And I mean, if we can appraise it, we can appraise it, and if it's there too. I mean, I hope another thing too. I've seen these in contracts where there's been concessions for buy downs, and I've seen them actually in the contract. So I've seen that's become more prevalent, which is funny that you're talking about it because we just read through a couple. And I hadn't seen one in a little bit, but we just read a contract the other day, and I was reading through the rate buy down. I was like, okay, this is interesting to me to have this in here. So
I mean, we always advise just write it towards buyers. Closing cost prepaids.
Well, I called and interviewed the agent, and they're like, "Well, this is what we're doing." And I was like, "Okay, this is pretty awesome."
I would say, in my personal business, probably 30 to 50% of the loans in my pipeline have some kind of seller concession paid buy down.
Okay.
It's just that impactful, and we're talking about it from the very beginning. We're explaining to the buyers that if you're going to negotiate, some houses you just can't negotiate. Just is what it is. It's a hot house. You're going to have to pay what they ask. But if you're going to negotiate, this is the sacred number.
Yeah.
The seller concession is sacred. Do not give it up, period.
Right.
So, and our agents have been really good at negotiating those. So.
Well, I mean, and by the way, just from an appraiser standpoint, I mean, we need that information when we're analyzing the contract. So that's why people are like, why do you need the contract? I'm like, well, we have to analyze everything that's part of this contract.
Yeah.
That we have to analyze the contract for the every purchase and sale. We always request it multiple times. Yeah. And your company prefers that we actually review it.
Have to.
And analyze
have to. Fannie says you have to.
Yeah. I mean, so we analyze that kind of stuff. So anyway, I think that's really important.
But it is important. I mean, you think about how do you value the asset of something for sale without knowing the terms of said sale?
Right.
You know, I mean, it would be, I don't know. I do get the argument that it's like, well, you know, maybe it'd be better if you didn't know the sales price and you just came up with a number out of the air.
Oh, yeah.
Okay. But the actual terms of that sale are very important to
there could be something in there that we really need to know about. There could be an additional parcel or something that's not being included. There's things that we need to know that need to be part of that. So I think it's important.
Cool.
I do want to talk about like just our micro market, like Knoxville. I think Knoxville City needs to do more in regards to zoning and increasing density. They're not doing enough. We're lagging behind Nashville, and people are like, well, Nashville's too big. Well, we have an affordability crisis. We do not have enough inventory. We don't have, I mean, you know, we were talking with people about rents before this too. I mean, rent rates are skyrocketing. The dream of home ownership may be a while, you know, for some people. So Knoxville City has an affordability crisis as far as like housing, and our zoning is partially to blame for that. We need to increase density in certain areas and be able to do that. And we have places where there's infrastructure, right, where we can increase density here. Another thing too, the city, when you pull a permit, I don't know if they're understaffed, but every developer and every contractor that I speak to talks about how long it takes from putting in a permit to being able to build. Now, I'm not saying let's go willy-nilly and build just whatever and just like pass it off, but that's hamstringing us as well. So we lag behind Chattanooga and Nashville because they've increased density, and they have things, you know, in Nashville, I call them tall skinnies.
Yes.
But they're the houses that they put on
horizontal property regimes.
Yeah, HBRs, dude. Yeah, you're in the know. Yeah. So Knoxville has one.
Yeah,
that I know of, and then
Knox,
and then I talked to a guy, Josh Henson, and he did one, but he didn't even. He's like forefront of like it here. He's like, yeah, I did it, but I didn't even know that's what it was.
Yes.
So I mean, there's HPRs, and that has to do with our zoning and density, but we can increase that.
Yeah.
And you can even have things like I talked to a realtor, Bartholomew. His last name. Anyway, he's trying to figure out a way to develop like what he's calling a pocket subdivision. But the density and the zoning has to be there to allow for this little pocket subdivision of like maybe even smaller houses.
Yep.
I'm not saying tiny houses, but stuff that's like 500-600 square feet, from 400 to 600 square feet, where somebody can actually own a house and develop some income and have a place, whatever. So we lag behind them. Chattanooga went and got the fastest internet in the whole nation.
Universe.
Yeah, I mean, it's fast to get people down there, but they've also changed their zoning laws, and they've also revamped the way that the construction permits and everything's pulled here, and we just sort of lagging. We are way behind those guys here. So
I mean, even I was at MTSU over 10 years ago, and I remember there was attached PUDs everywhere.
Yeah.
Attached PUD communities everywhere. Old South was the big builder of attached PUD communities.
Right. Yeah.
And that's what everybody bought as their first house.
Yeah.
And, you know, 100,000, 135 at the time.
Yeah.
Probably selling 350, 450 now, you know?
Easily.
But it got you in the game.
Yeah.
It's a PUD, so you own the dirt underneath it, which is important for us as lenders that it's not a condo. Condos get tricky.
Yeah.
And really the only builder that I know that's actively pursuing attached PUDs right now is Turner.
Yeah.
And I would love to see more of those, but it may just come back to zoning. I don't know those details.
Turner's doing some. Josh Henson is doing some stuff. He's done some really cool stuff out in South Knoxville. He's doing some stuff off of Westland, where he bought a big tract off of Westland. He's doing some things there. But yeah, we don't. But it's because the process to get it up to that, and the zoning and going before MPC and doing everything else. And I understand we can't just put it everywhere. I get it, right? There needs to be an infrastructure, road work, sewer, septic, or sewer, electric, water. There needs to be access to, and then, we don't want to congest certain areas. I understand all that. But in places where we have infrastructure in place, the density and the zoning needs to change for us to allow to do that. So, and it hasn't. And it hasn't fast enough here, So, we're lagging. And then just back to, not just to get off the tangent with Knoxville City, there's inventory now, but affordable inventory not so much, And so these lateral moves for people, with a 2 or 3% interest rate isn't very appealing.
It's also inventory neutral because they're selling and buying. It's not, it's not creating more.
Yeah. And it differs in certain markets. Now, we'll tell you this: like there is a oversupply right now of 1 million plus cabins in Sevier County.
Oh yeah.
And so I can show you that data without a doubt that there's an oversupply there. So that eventually, simple economics will tell you that prices are going to come down.
Yep.
Right?
Yep.
They'll eventually come down. So we'll see that. But I mean, guess what? You can build a house like that in Sevier County.
Yeah.
Just get out there and they'll let you go do whatever. I mean, and I'm not saying they're willy-nilly either.
Sure.
But I'm just saying they have an oversupply of property because it's easier to build and the density's there.
Yeah.
I mean, those don't even connect to sewer. Half of them are on septic tanks, but they know that they got to get these things up and out of the ground and built, right?
Yeah. It'll be like 6,000 square feet, 3-bedroom. You're like,
yeah.
Is it, or is it on a 3-bedroom septic?
Yeah, right.
That's what you see.
Yeah. No, but that's it. But I mean, just because the county or the city is not really encouraging, but has everything in place to have this happen a little bit quicker.
Yeah.
And we're behind the 8 ball in Knoxville.
Yeah. Yeah. I mean, it is a problem. I've wondered why we haven't had attached PUD communities here. And it's interesting to me that you said that about HPRs. I've also wondered why we haven't had that here.
There's one now.
Because, I mean, they've been doing that in Nashville for 8-10 years.
Yeah, I was watching developers buy whole streets of duplexes and convert them to HPRs.
And selling for like $1 million plus a piece on like, I don't even know, just not even an 1/8 acre. I mean, it's
right. And the houses,
reach out and touch the one next.
Well, the houses are beautiful and they're in great locations and they're great. And I mean, you got to look at it from a standpoint too. I mean, you're just increasing another house on a parcel, but look at all the money that comes in from taxes from that other one. You got two $2 million, you got two $1 million houses instead of one $650, $700.
Right. Yeah.
So I mean, just the implications from the revenue would go to the city and be there. I don't understand why we're so far behind and why we lack and why it takes us so long to do everything that we're doing.
Yeah. Well, maybe you can run for office.
No. I want to be underneath the radar. I don't want to be underneath of the radar. No way.
That's awesome, man. Well, hey, thanks for your time today.
That's awesome.
Anything else we should cover? And we solved a lot.
Did we?
Talked about a lot.
Okay. Yeah. I think no, nothing else to cover.
Yeah.
Be dynamic.
I agree.
Be Netflix and not Blockbuster.
We do see this to that point. I've been talking about this a lot. We were with Fairway in Atlanta the first 3 days of the week for a branch manager Southeastern Region conference, and there's a huge changing of the guard in the real estate industry of originators that historically dominated,
right,
to who is now kind of stepping into the volume picture. Same thing real estate. You're seeing a huge change in the guard in the realtor picture,
especially with this recent lawsuit.
Yes. And it's not even I don't think it's specific to age. It's really about who's adapting and then who's waiting on something that happened twice in a century but may not ever happen again.
Yeah, Sears, Roebuck, or Amazon.
That's right.
I mean, what are you going to do now? And everybody has this really great opportunity right now to figure out how and to develop new processes and systems to adapt.
Yep.
right now, realtors especially too.
Yeah.
I mean, maybe there's some opportunity for appraisers, and originators, for loans out there with this new NAR settlement that we don't know about. I mean, and so I always look at it like, hey, we're probably going to benefit from this because I'm going to figure out a way to be dynamic enough to benefit. And I hope, and I know you guys are too. That's that was your whole thing in Atlanta, right?
That's right.
Okay.
You talk about being the authority. Anytime you have an opportunity to be an authority on something new or something, I think that's a value to the marketplace.
Yeah, you want to be the authority because the expert's like, I'm not sure if that's where you can be an expert, but I think the authority is a little bit higher level or a plane. So and that's what you guys are, and I guess that's what I want to be. So
I'm
okay,
that way.
Okay, that's good.
Yeah.
Okay.
Well, man, thanks for coming and telling your story.
Yeah, it's great.
We'll do it again. So thank you all for joining in, and we'll see you next time.